So this is the time of the year that I get to do the market update for you all. As Andrew pointed out, I've been doing this for 9 years now and I quite like it. So hopefully you might enjoy it too. So I'm going to start with some of the interesting news over the last 12 months. I'm then going to look at returns. I'm going to change tack a wee bit after that and talk about socially responsible or ethical investing before I look at what's happened in 2019 and what that might or might not mean for what's going to happen in 2020. So, it has been an interesting 12 months. The US and China have engaged in a tit-for-tat battle with tariffs and counter-tariffs, walking towards and away from the bargaining table. If President Trump is to be believed, China are walking back this month. It's been volatile. That other unconventional leader, Boris Johnson, has lurched precariously from a no-deal Brexit on a hard date of the 31st of October to a Brextension to a non-no-deal Brexit with an election before the end of the year. That's an interesting part of the world too. And Hong Kong has become a hotbed for political protest, self-determination and all-round trouble. We've heard more this morning about rubber bullets and water cannon and all sorts of protests going on in that part of the world. Now, it has undeniably become something of a powder keg, with President Xi Jinping with his matches in his hand. What happens next, we don't know. Earlier this year, we were able to, well, not we, the world's scientists were able to capture the first image of a black hole. Now, interestingly, this is all the result of really big telescopes and international cooperation amongst scientists. It's quite neat that they can do it. It'd be nice if maybe some of the rest of us could. And of course, earlier in March this year, our Prime Minister became a byword for empathy as New Zealand responded in the best way possible to the tragedy that we experienced here in Christchurch, with love and not hate. Earlier this year, the very first day of 2019, Qatar left OPEC. That's a pretty big change, but didn't get a lot of coverage in the news media. And Saudi Arabia had its oil fields attacked by terrorists. And actually, as we speak, Saudi Arabia are going through the process of an initial public offering for what will be the largest company in the world. Aramco, which is their national oil company, is going to be valued at $1.7 trillion. Just felt that needed to hang. 1.7 trillion. They're looking to sell off 1.5% of that company in the initial public offering for the paltry sum of $25 to $27 billion. Not bad, really. Interesting. Now, of course, oil is old energy, so we're told. Now, the prospects of oil must be pretty good for a company to have a valuation of 1.7 trillion. That's actually below the initial prospective valuation of 2 trillion. So, no. And then we were unjustly robbed of a certain trophy in the middle of the year by an umpiring blunder. I'm not still bitter. My cufflinks might indicate that perhaps I am. And then we were justly denied a three-peat in the Rugby World Cup by a team that turned up and played much better than we did on the day. And then, of course, they turned around and lost to a South African side that turned up to play pretty much their perfect game the next week. And how could I possibly finish off discussing the news of 2019 without addressing President Trump and his potential impeachment? Impeachment's actually a pretty big deal. There have only been 2 US presidents impeached in the history of the United States. One, Bill Clinton, widely regarded as one of the better presidents of the United States, go figure, who you've probably all heard of, and another, Andrew Johnson, who pretty much very few people in this room might have heard of, but widely regarded as one of the worst presidents the United States has ever had. Now, if President Trump gets impeached, it'll be interesting to see quite what the data winds up saying about good or bad presidents getting impeached. So all in all, a fairly messy, fairly interesting year. Well, what about the economic news? Economically speaking, given that news probably wasn't that great, what did the news look like? Well, not good again, I'm afraid. World GDP growth has slowed from around about this time last year, when world GDP growth was sitting at around about 3.6%. It's now down at 3. Now, within that number, developed market GDP growth has fallen from 2.3% to 1.7%. So the world's economic growth is being dragged along by the emerging market economies who are growing at 3.9%. That itself was a fall from how they grew last year at 4.5%. Now New Zealand, we're pretty good, relatively speaking. So as we think about other developed economies, sure, our growth has slowed quite a lot from 3.2% down to 2.1%, but we're still ahead of the average of 1.7%. So what does that mean? Well, it has meant that interest rates both here in New Zealand and around the world have fallen. This is what monetary policy does. It decreases interest rates to try and stimulate activity in the economy. New Zealand's interest rates have fallen by 0.75% over the last 12 months, including a surprise, at least in quantum, 0.50% cut in August. Now, the US Federal Reserve, they've also cut rates by 0.75%. The Reserve Bank of Australia, they've also cut rates by 0.75%. Overall interest rates around the world are low. The New Zealand official cash rate, 1%. The Fed rate, that's the equivalent rate in the United States, 1.75%. The RBA, the Reserve Bank of Australia rate, 0.75%. The Bank of England rate, 0.75%. Here's where it gets interesting. The European Central Bank rate, 0%. But it's a bit more nuanced than that. So the rate that the European Central Bank will earn if someone borrows money from them, because it's an overnight cash facility, that's what these central bank rates are, they'll earn 0.25%. Now, if a European bank actually puts money in the European Central Bank, the ECB will charge them 0.40%. That's a negative interest rate that those banks will earn from having their funds with the ECB of 0.40%. That's interesting. The Bank of Japan, it has a headline negative rate. Negative 0.1% is the bank's interest rate in Japan. Wow. That all sounds pretty negative, doesn't it? I try to be somewhat upbeat at these things. That data indicates that it might be a bit hard. That data indicates that we might be able to expect some weak returns. We'd be wrong. Not only have the last 12 months delivered positive returns for every asset class that we monitor, but they've been above average returns. And in some cases, not a little bit above average, but a lot. International shares, if you were hedged or unhedged, 11% above average. New Zealand shares, 24%, well above average. Australian shares, 18% above average. Emerging market shares, 14% above average. International fixed interest, long-dated bonds that have been hedged back to New Zealand dollars, almost 10% in returns. That's really high for fixed interest. New Zealand fixed interest, almost 7%. Bad news, weak data, good returns. That's surprising. How about we look at it another way, because sometimes returns can come in spurts, so we don't know where they've come from. So this is the same data, put in a different slide. I like my charts, as you may have found out by now. Now, up the top here, resplendent in purple, 3 daughters, so there's purple and pink in my slides, just deal with it. If we started off with $1 about a year ago, invested in New Zealand shares, it'd be all the way up to $1.24 now. In second place, in the pink, well, that's Australian shares. $1 invested 12 months ago would now be worth $1.18. And in third place here, this is emerging markets in the sort of baby blue, that'd be worth $1.14. That's interesting. Now, those of you who have been to these before or have listened to me before will know that I like data, and 12 data points is not very many. It's interesting, but it's not very many. Before I move on from this slide, I will point out this one. So this was the December quarter. Now, I'm not saying there's any correlation or causation here, but the last time I had this discussion was around about here, and we went down. Again, correlation without causation. But that's going to become interesting, particularly in the next slide. So, 12 data points is not very many. 1 year is interesting, indicative, but not particularly informative. How about 3 years? So this is 3 years worth of data, 36 data points. which is much more indicative, much more likely for us to be able to draw some conclusions, or at least make some indications. And this has certainly been a much more interesting ride. But overall, it has still been a really positive journey. Here is that December quarter again. And it wasn't much fun. Actually, the December quarter was the worst quarter for diversified investors since the global financial crisis. In fact, December of last year was the worst month in developed markets since the 1930s. That wasn't much fun. However, notwithstanding that, the 12 months back here, everything up, even though down here they were pretty low. In fact, a diversified mix of 50% in shares and property and 50% in cash and fixed interest would have returned almost 12% over this time period.
What happened in December 18? Anything in particular?
Well, really, that's a good question, Chris. So those of you who didn't hear, Chris just asked what happened in December 2018 to cause that drop. That was probably the beginning of the US-China trade wars, such as they were. But other than that, not a lot.
Glitch?
Well, it certainly seems like a glitch as we look now at where we are. So over this 3-year time period, $1 invested in New Zealand shares, still in the lead in purple up top, would have been $1.60. And second, this time we've got international shares with a value tilt, unhedged, $1 would have grown to $1.47. And Australia now in third place, but still in the pink, would have grown to $1.44. Really strong returns. Well, that's interesting. Last 12 months been really strong, last 3 years been really strong. Over that time period, there hasn't been a great deal of positive economic news. And yet, here we are. All lines point up. Now this point, this was hard work. It would have been really easy around about here for those of you in the room to have looked at your portfolios and taken the sugar hit and gone, you know what, this is hurting, I want out. It would have been a profound mistake, but it would have been really easy to do. The return that diversified investors have earned is the reward for the discipline that you apply to your investment process. It is the trade-off that we accept the risk for. We accept the risk to earn the expected return. And it's worked out pretty well. So, I'm going to change tack now and talk a little bit about socially responsible or ethical investing. SRI, ESG, there's nothing we can't turn into an acronym in this business. Now, socially responsible investing is all about investing in a way that's consistent with your worldview. Typically, it involves reviewing investments and considering things to leave out and things to put in. So there are 3 headings: environmental, social, and governance. And the governance ones, actually, that's a no-brainer for every type of investment. Good governance is just good practice. Ensuring that you have some independence on the board, ensuring that executive remuneration is sensible. These are actually all things that the data suggests will be positive for expected return over time. So this is the kind of thing that we should always focus on. Point of order, Cambridge Partners does have an independent chair, just so as you know. Now these other things, these are a little bit more tricky. The challenge that is often the case with SRI is that it is a spectrum. When you're investing to try and be consistent with people's values, you're investing in a way that reflects their views. Now, people will be on a continuum. Some people will be more focused on some things than the others. Now, I actually have a confession to make. So, when I was putting together this presentation, I didn't think I was the right person to do this bit. You may or may not have deduced I'm something of a cynic. I'm a skeptic. I like evidence. And all of this stuff just seemed a bit woolly for me, really. I didn't think it was for me. And I've been around a while. Not as long as some of my business partners, I concede, but I've been around a while. Now, the first time I came across SRI or ethical investing was in the early 2000s. And I always look to the data, and the data in the early 2000s was compelling. It was dreadful. Very high fees, concentrated portfolios, and lower expected returns. Much lower experienced returns. So I folded my arms, I furrowed my brows, and I said no. Because we take our job as stewards of your wealth pretty seriously. It's actually something that gets us up in the morning and keeps us up at night occasionally. It's really important to us. So that cynicism and that scepticism are pretty good qualities, because it means actually we dig down and we consider why. So I had to look at the evidence. And I've had to change my mind a bit, because the evidence has developed and the evidence has changed. What has happened is that the options, the opportunity set for investors to invest in a socially responsible way have changed. In the early 2000s, not good. The early 10s, getting better. 2015, 2016, actually the opportunity set was limited. So now what I have on the left-hand side here are various asset classes, and in each of these columns I've got a light green where the problems of that asset class just don't exist. So for example, in New Zealand and Australia, you can't invest in a company that grows tobacco or makes nuclear weapons. They just don't exist. So it gets a light green. It's a tick by proxy. In the red, that means there's no way for us to understand what's in those investments, and they do include some of those things that we don't want. The dark green, well, that means either they're screened out or they're not an issue. So in 2016, not a lot of options. In 2017, well, actually, now we've got an option, a deep green, a dark green, to screen out some of the harmful things in international equities. So we can screen out tobacco, we can screen out weapons. Still a little bit tough in global bonds, but actually later in 2017, we're getting closer. We make an improvement. In 2019, well, now we can do pretty much everything. And that's cool. But again, I always come back to the data. And we now offer SRI portfolios for investors because we want to be able to reflect your values in your investments. Now there's a trade-off. Historically, the trade-off in terms of expected return for the level of risk was too high. There's still a trade-off. There is some lower expected return from ethical or socially responsible investing at the moment. We don't know that that will always be the case, but there is right now. But now the trade-off is acceptable. Now the trade-off is something that we can quantify, and we can still determine whether or not a client can meet their objectives. Because ultimately that's the job. Now, we are stewards of your wealth. It is our job to do our very best to give you every chance of achieving what you want. Now we have an additional opportunity set within which to play, within which we can help you invest in a way that reflects your values. Now, I apologise, this slide is basically illegible, but I'm going to walk through it, so it's okay. Now, I said that I would talk about 2019 returns because in the context of 2020 returns. Now, to get there, I have to talk about 2018 returns, and it'll become apparent why. So, 2018, now this bottom row, the sort of teal with the black border, this is a 50-50 mix of cash and fixed interest and shares and property. And along this row is every return for right back to 1999 for this portfolio mix. Now the 2018 year, negative. Negative 2% for the 2018 calendar year. Now that was largely all due to that December 2018 quarter. That was about a negative 4% quarter, by the way. Not much fun. Well, that's not great. Why are you pointing that out to us, Scott? We don't like to be reminded of that. Well, the reason I'm pointing that out to you is actually for the calendar year of 2019, the return for that same mix of assets has been about 12%. That's a pretty good return. Now, well, what does that mean? Well, actually, let's look back and see if there are any other negative years. Well, right back here in 2002, that was the dot-com crash. I think that's where Jacob and Andrew lost their hair. Negative 5%. Whew, not much fun. However, the next year, 2003, this mix of assets provided a return of 11.8%. Huh. What about the next negative year? The next real stinker, again, technical investment term, is the global financial crisis year. So that's 2008. Now, a 50-50 mix of shares and cash and fixed interest would have delivered a return of negative 8.2%. That was hard work. Not many people enjoyed that. The next year was a return of 17%. That's a pretty good reward for patience. Now, 2011 doesn't quite qualify. It's a 0.1% return year, but it's a flat year. The following year, 2012, delivered a return of 12.4%. I've just pointed out that 2018 was a return of negative 2%. 2019 year to date, around about 12% for this mix of assets. That's interesting. That looks suspiciously like a pattern. Whoa! I'll stop you right there. I'm an economist, and those of you that know me know that economists exist to make weather forecasters look good. Where you think there's a pattern, there isn't. What this is the quality of averages. Those of you that can remember fifth form maths, and I can see one person in the room who never did fifth form, would have been year 11, this is the quality of a bell curve. In the middle of our bell curve, we have our long-term average. To the left-hand side, that's the bad side, we have our negative returns. To the right-hand side, we have our good returns. We like the right, don't so much like the left. But unfortunately, to get the right, you need to take the left. In the middle is the long-term average. Now, if the long-term average holds, if reversion to the mean, which was Andrew's stats joke from earlier, holds, then after we have a negative return, on average, we're likely to have a much higher positive return to get us back towards the average. That is all that it is. So, 2019 has been a very strong year after 2018 was a negative year. What does that mean for 2020? Well, on average, it should be an average year. So we're anticipating that we'll be much more like closer to a 6 to 7% return for that 50% shares and fixed interest mix, rather than the 12 to goodness knows what it might be by the end of December return that 2019 looks like. That's my time. Now, I'm going to hand over to Jacob, who's going to introduce someone that I'm very much looking forward to. I'm around for questions at the end of the session, so please feel free to find me and ask.